agreed to. The Honourable David Parker.
Yep. Thank you, Mr Speaker. The Labour Party supports this bill. Can I thank the Minister for his comments? This is housekeeping legislation, which is nonetheless important housekeeping legislation, which regulates the way in which our commercial sector has to prepare its accounts and the standards which they have to apply. And in respect of financial reporting, we're trying to get the balance right between standardisation and proper principles being applied in respect of accounts that are prepared for entities that have lots of people who rely upon them, and the accounts that are prepared by smaller organisations where it's really a small group of people with no public outsiders that need to have access to the information in a reliable and comparable form. And this bill tries to do that by making some differentiation between larger companies and smaller companies. Larger companies and large overseas companies that carry on business in New Zealand have a slightly different regime. Large is defined as companies which have assets exceeding $60 million or revenue exceeding $30 million, and that's assessed over the 2 preceding accounting periods. I'm not sure whether that's $30 million in total over those 2 years from memory, or whether it's $30 million per annum averaged. But in any event, you can see that in respect of companies that have got $60 million of assets or revenue exceeding $30 million, they're large companies, and for them the compliance cost of being required to comply with each and every of the increasingly complex requirements of the general accounting principles and the specific requirements that come through from the accounting rules bodies that are run by the Accounting Society and the like, which are increasingly international rules. You can see that it's no great cost for them relative to the side of their business to go to the nth degree and prepare accounts that are very detailed. In respect of companies with, that aren't quite that big, but they might have 10 or more shareholders, then if they have a vote amongst their shareholders and their shareholders by 95% majority want to opt out of compliance, they can. And I support that as a measure as well. That's very sensible. I agree that it ought not to require unanimity, because one shareholder who was a troublemaker or had fallen out with the other shareholders could effectively impose quite a large financial burden on the rest of the company, despite the fact that 95% of the shareholders were happy to opt out of strict compliance with the most precise form of financial reporting. And there, then in respect of companies with fewer than 5 shareholders, the rules, fewer than 10 shareholders, the rules are slightly different again, as I understand it. There, if shareholders who hold 5% of the company shares require the company to comply, then it must comply. But unless they do, they don't have to. So the onus is different there. In the respect of the 10 shareholder company, the default position is it has to comply unless there's a resolution with 95% support which says that they don't have to. And in respect of the smaller company with fewer than 10 shareholders, the default position is that they don't have to comply, but if 5% of the shareholders say we want you to, then they have to. I think that's an improvement on the status quo, and I think that will reduce compliance costs and accounting bills. I wasn't on the committee that heard this submission, but I would imagine that the Accounting Society were supportive of the changes. And can I thank them for that, because they have tensions within their own organisation, because there are some of their members who profit from the more complex requirements of greater specificity of compliance with accounting rules, and for them to put their self-interest aside and say that, look, we think that on occasions companies should be released from these more onerous obligations, shows that they have an interest in the performance of the New Zealand economy and keeping compliance costs at a reasonable minimum. In respect of audit requirements, the same opt-in and opt-out rules apply. This again is a very good change. Large companies, other than those that are required to register their financial statements, so if you're a public issuer of securities to the public, for example, you have to register your financials, you have to file your financial statements with a regulator every year, and effectively you can't opt out of audit requirements. That arises, I'm not sure whether it's from this legislation or the securities legislation, but if you're a public issuer, you have to have audited accounts. What's the FMC, from the Financial Markets Conduct Bill. Large companies that aren't public issuers can opt out if they have a 95% majority vote from their shareholders. So again, the default is that they have to have an audit, but if the shareholders pass a positive vote with 95% support, then they don't have to go through that audit cost and they save that cost. In respect of those audits, they've got to be carried out in accordance with auditing and assurance standards, but the registrar in respect of overseas companies can recognise overseas standards. Charities will be required to prepare financial performance in accordance with generally accepted practices. Currently, there are no requirements in respect of charities, and given some of these charities, or a lot of these charities, take money from the public, it's appropriate that we have some level of transparency as to what's happening with the money that they say is to be used for a charitable purpose, and we want to ensure is. The PricewaterhouseCoopers PwC view was that removal of the preparation requirements for detailed accounts for small and medium-sized companies and the relatively high large entity threshold means that most companies in numeric terms will no longer be required under the legislation to prepare GAAP financial statements. And that's an interesting point to note, an important point to note. I know that in the past, politicians often get it in the neck from people who are running businesses saying that it's the tax man that drives a lot of compliance cost. Actually, in some cases, it actually hasn't been the tax man that's been driving compliance cost. It's been increasingly complex financial reporting requirements, which have been required at a high level by government legislation, but at a low level have been made more complex every year by way of changes to the accounting rules that actually haven't been considered by Parliament but have been imposed by the bodies that are responsible for financial reporting rules, namely the accounting body that's responsible for those rules. Mr. Speaker, I don't have time to go through the finer technical details of this bill, which runs to 169 pages. Can I thank the Commerce Select Committee and the chair of that committee for the work that they did to bring this back to the House with the support of all parties, and the changes that were made at Select Committee have the Minister's agreement, and we've got a better bill as a consequence, and again it shows the importance of Select Committee processes, and I think that's a wonderful thing that we've got in New Zealand, that the likes of PwC or other people who are interested can come to Select Committee and say, look, we agree with this in general, but could you tweak this because it's not quite right as it is, and we do it Select Committee, and then as a consequence we get more practical legislation. And I think that's probably one of the reasons that though New Zealand's got a small bureaucracy by international standards, and we've only got one House of Parliament, we still manage to run our country in a way that's pretty efficient because of the quality of our legislation overall. So, Mr. Chairman, Mr. Speaker, the Labour Party is supporting this financial reporting bill and recommends it to the House.
Mr. Speaker.
I call Jonathan Young.
Thank you, Mr.